I think it goes back to the original question, just bringing us back as an investment theme before we get into some of the other stuff, which we got to talk about private credit and interest rates and macro and everything else. But is stock market investment theme, if that's the case, if we're on well, I guess the question is, where are we in that possible process, the adoption cycle? Are we still on the kind of the initial wave? Is it in maybe rolling over, heading lower? How do people set their expectations for, okay, if this is a traditional adoption cycle, then that means there's going to be an up and down, and then we want to get into it on the bottom, on the other side. Is there more room on the top, you think, or are we already on the rolling over part of it?
We're on the rolling over part. And like, so in that last essay and on my podcast, I kind of shown like, if you just do hyperscalers and include the UBS hyperscaler index, which includes Oracle, and do it relative to the S&P, you saw that it was getting rewarded for all these CapEx. And you remember the month after we were in St. Bart's last year, you remember September, it was like, this press release comes out, non-binding press release, nonetheless, $100 billion of market cap added. And, you know, the crescendo of that was Oracle going to 341 as its IG, or as its, you know, its credit spreads at 45. Well, since then it's down like 60 some percent, and its credit spreads are now trading like junk, 200 on the CDS, and the private market's 300. The market kind of figured it out then. And to be fair, like the real bubble stocks or the real bubble assets actually did pop in that early October period, right? Bitcoin was at 125 and it's halved since then, right? The fake stocks like SMR and Oklo, which are like next generation small modular reactors, like interesting technology, but again, not relevant to today from an economic model. They were high flyers. They're down 70%. So and that's what we saw actually more recently. If we can go back to the post-COVID period, go back to like what happened in 2021. Well, the ARC, you know, and SPACs and the most speculative stuff that actually peaked in the Q1. Right. And then you had as the year went on, then you went to the junior growth guys, and the S&P held on till the end and they got that Rivian deal off. But sometimes these rollovers are a process, not just an instant. Right. Like COVID was a volatility event. It wasn't the end of a cycle. The GFC, like, let's just talk about the GFC. I mean, I was a young grad student and I could see it coming in '04 to the point that I knew we had to be bullish for another year because you could just see those arm resets coming. But I knew '05 would be okay. And that was 4 years, right? Like, you know, I mean, think about all the guys who were bearish in '05 and '06 and just watching the S&P hang on. And even like,
and getting ridiculed endlessly for it too, right? Because that's always happens. That's another late stage cycles, as all the bears are ridiculed for being way too bearish and not joining the party.
Yeah, but if you think about that, like Q2 of '07 was really the height of that. And then you had the Bear Stearns credit funds blow up. And then in August, you had the quant populist, you know, where AQR was down 50%. And as we both would agree, August 4th or August 5th, whatever, was when the GFC actually started and the funding markets broke. And that's still, by the way, that's still not that well known. It's actually kind of incredible. Despite all your efforts, Jeff. Like, yeah, still.
August 9th is the date when BNP, they announced that they couldn't value their fund, the money market fund. And that was like, okay, we're not even valuing money market funds anymore. That's the end of this. That's the end of it.
Yeah.
But you're right. I mean, that's the point, though, is that rollovers and crisis and all these things, they are prolonged processes. They are not, you know, snap your fingers and it happens. So in a lot of ways, that's it makes it ambiguous and difficult and confusing, but also makes it good as an investor, which means you don't have to hit the exact top, because there actually isn't an exact top. There's an entire process. So I think part of the lesson is to be faithful to your analysis and stick with it, even if you're seeing things, you know, like you said, the markets are still going higher and higher and higher, but even though the early parts of it have already popped.
Yeah, and I think there's also like more nuances to it. If like, okay, so the hyperscalers were these titan companies that had, and let's just remember about the hyperscaler, or, you know, like they were built on the back of a bunch of bankrupt telecom. So the guys who did the infrastructure laying, they all went out of business. And then these guys were like, well, we got the software, and they became titans, and they had 20 years plus of being these, you know, capital light compounders, right? Like there's a whole compounder bro meme about it. And it's like, okay, well, new technology came around that's like changed the dynamics of the internet. And these guys are like, well, we want to stay relevant. And so we're going to have to invest in order to stay relevant, right? Like the only guy who didn't invest, which is now back to being the king again. Apple's back as the number one market cap, which is hilarious, by the way.
Oh, no, Apple, why aren't you joining the AI bubble? And Apple's, maybe not.
we're good.
Yeah,
You
we'll
know,
see how this goes, right?
well, like the interesting dynamic of Apple that it's like, I don't know if they knew this or they were just like, hey, we have a quasi monopoly on if you lose your AirPods, you go get another pair of AirPods, or you lose your iPhone, you go get another iPhone, because people don't like to switch systems and you only have one other choice. Well, not for AirPods, but for phones. And so, or it was like, hey, we're going to wait till this blows out because we've seen the historical analogs and then we'll buy this IP on the cheap. Or the final one, which is a big dynamic happening in AI, is open source models are becoming a real thing. I mean, local models, right? So you own a GPU and then you run your model locally. And so it comes on a device versus having to give the money to the cloud. See, this is probably the biggest risk to the way the market's structured right now. And this is why Jensen is all in. I mean, that's why he's funding, all this stuff. CoreWeave. Now he's giving OpenAI money. Like he wants, and by the way, they're also giving free access over API to their 80 LLM models that they've built because they want you to own a GPU, or me and you and all the guys that we know say, oh, we'll all chip in. We'll have our own GPU and then share it. And then we'll have our own local model versus just be endless cloud, slaves, if you will. And so there's a real battle here where you have NVIDIA and the hardware and infrastructure guys on one side, and Apple being one of them, and then the cloud guys on the other side. It's really clear that the market finally realized Apple is sitting pretty good again. And these other guys, they don't know what their place will be. I mean, in the old days, Microsoft and Meta and Google, they were in their own lanes. Now they're kind of all competing with each other. And I don't know, knife fights are never really good things. I mean, capital investment that's heavy with pricing pressure that's serious and no real moat on these LLMs, it's just not great for capital.
No, but it's great for the economy because competition like that is always great. So yeah, you're right. For an individual stockholder, you're like, shit, which one do I bet? Which one do I pick? Which is always a challenge in the adoption cycle. Let's switch gears a little bit here. Let's talk about private credit because I think that's a natural flow from one to the other, right? The AI bubble is really as much a debt story as an equity story. And so you're starting to see all these, I don't want to say they're weird signs, but they're consistent with the credit cycle that seems to be rolling over on top of everything else. So you've got Oracle is sort of the I hate to say it, the Oracle for the debt story, as you just mentioned. The credit default swaps, debt trading like junk. You see that continuing to go along the same way where the private credit bust, if you want to call it that. I call it a bust. I think it's a bust in the cycle downturn. It starts to broaden out even further. Or I don't want to use the word from Ben Bernanke. Is it contained in a small area? Is there a chance that we can get through maybe an off ramp where somehow there's enough liquidity in the system just hanging around the margins and the edges where people come in and bargain hunting on some of these issues? Or where do you see the private credit story going overall?
So it's nuanced, right? So if you remember last September, we had those lenders that were like Fugazi come out and everyone's like, wait, what's going on? And so, an interesting chart to look up is pull up the KBX bank chart and then put it against the private equity, S&P private equity chart, or the BizD, all the BDCs. And they're in macro, we like to look for jaws, right? We're like, hey, the jaws have to close. And so it's been basically an issue there, but I don't think the hyperscaler part of it really got into play at least in the public's conscious. I think credit investors were aware because you can look at Oracle CDS blowout and you can see the hyperscaler, but some of that is also regulatory where the banks that hold some of this stuff, because of the rules have to own some protection. And, credit default swap market has not been a very liquid market since the GFC. So in that sense, the new issuance of Meta has CDS now. CoreWeave has CDS. SpaceX has CDS within a week of them going public, which, by the way, just got absolutely torched.
Yeah, there's a total attitude change, right? In the first couple of years, go back up until, September, October, Tricolor First Brands comes out. Nobody cared about protection. Everybody was just about volume. Give me more, give me more, give me more. Now the conversation has shifted. And I guess the question I think we're trying to work through is how far has the conversation shifted? Is it gone to the point where there's no going back?
No. So I own a bunch of on the run high yield CDS of the index, and that is still tight, right? It's that I'm looking right now on the Bloomberg, it's 316, IG's at 53. So we're still near the tights, right? So you're having this what you got to do is look under the hood, right? Like anything, you look where the cracks are first. And so the cracks are clearly in the, the CoreWeave's the center of everything, right? Like CoreWeave will be a donut, in my opinion. And, basically no one needs CoreWeave. These are just former Ethereum miners that like caught it right. And by the way, you'll appreciate this, Jeff. You know who backed those guys? Magnetar. The Magnetar guys, right?
Yeah.
And it's funny because like I wrote this whole thing about how this is all Magnetar 2.0. And so for all the listeners who don't know Magnetar, they're one of the smartest hedge funds in the world that no one's ever heard of, unless you're a finance nerd like us or a practitioner. And they were the guys who kept the credit cycle going for about an extra 18 months. Because they basically did a genius trade where they funded these CDOs that would come out and they would fund the equity tranche, which everyone knew was a zero and was coming. They're like, yeah, we'll take it. And they would take the senior tranche and they'd take the senior tranche equity or income to pay for the mispriced CDS. And so they bought CDS at like 1% that paid off 90 times, crushed it, right? Very smart guys, right? And so they're the guys who underwrote CoreWeave. And they're basically out of 75% of their equity now. They made $12.5 billion on the trade, and they have some of the debt. So they'll probably be there just like they were the last time to restructure as well. So I think that you can think about the circular financing that's going on sort of in that like light of Magnetar. And it's just hilarious the Magnetar is behind the core like area, but like the hyperscalers probably will be fine. Those are, good businesses. Oracle will be a little binary. Like right now, Oracle's at 210 or something, and their data business is legit. The need for data in this AI thing is going to be huge. But at the same time, what's the ROI going to be on this CapEx? There's a duration mismatch between these leases and the length of, and so I think Oracle's definitely the Oracle, to your point.